Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be analyzing Medtronic stock. This one came in by request down in the comments section of one of my other videos. If you have a stock you would like me to analyze and create a video of, just drop it down in the comments section. If it's in the S&P 500 like Medtronic is, I post those on YouTube for free, and the rest I post on Patreon, which is $5 a month, and in the full Cyclical Investors Club service over on Seeking Alpha. Those links will be in the description. If you join Patreon, you can get a big discount to my full service. So yeah, drop any requests you have down there, and I'll take a look at them. As always, this isn't individual investing advice. This is just how I analyze stocks, and I tell you exactly what I think when I look at a stock. Medtronic is an interesting one. It's a good one because I wrote about it back in 2019 on Seeking Alpha as a sell article. And as you can see, 3 years later I wrote about it, and it was the only sell article written in however many years that was, 3 years. I'm not sure if anybody came in after that, but it's just, let's take a look at here. So since then, the stock is down about, the total, if you include the dividend, is down about 9 or 10%. The S&P 500 is up 60% during this time. So this is an example of a couple different things. One, let's go to the fast graph here. One is why valuation matters. And not everything is about whether we're going to have a recession or not. Not everything is about a name brand or historical long-term performance or the dividend and the dividend streak. They have a 3% dividend now. Everybody was bullish on this stock except for me, basically, back in 2019. And just looking back at it, I can say that the reason why is because it was probably trading, I think that was actually later, it was after this big rise here. So it was trading over a 20 PE, and which a person might say is not that expensive. But when you look at their history of earnings growth up until then, at the time I would have probably started it right about here. You know, if we just go back to what this looked like back then, it would have looked something like this. It had about a 6% earnings growth rate. That's if you don't include any buybacks. I didn't check to see what the buybacks are, but I account for those. But what you want to look at here is, why might a person be attracted to the stock at that point in time? Why was everybody bullish on it? Well, I think there are two reasons. That might be today. I'm not sure if it's from that time period. Let's check, actually. Yeah, 2.5%. One, it has a very steady earnings growth, and people pay a premium for steady earning stocks. Too much of a premium, in my opinion. But if you didn't look at the earnings and you didn't do a valuation analysis on this based on earnings, a person could look and they could say, they wouldn't even have to pick the bottom here. They could just pick any time in 2010. And the people who bought this all this time had nothing but great things. The stock returned almost 14% per year. It seemed to go nothing but up. Sure, there were a couple little snags, but the general direction was up. Earnings were always better than the year before, and that's just what people had grown accustomed to. And people like that, and so that causes people not to sell a stock. And so if people don't sell it, then it gets more popular, and then everybody's happy. And nobody ever looks at the valuation. Well, look at the difference in valuation between here when they bought it and did well. It was 11 PE, we'll say, up till here where it was, well, back here when I actually wrote about it, it was 20. Let's call it like double. So the PE doubled, and that's where a lot of these returns came from. So you can't extrapolate that out to the future when earnings aren't growing very fast. Usually what happens now, any different things can happen, but where was I at? 20. Yeah, we'll take that. Let's go to right here. And then let's go here. That ought to give us, yeah, this is about what I have. Okay. So, sure, a stock can sell off a lot, and we've definitely had stocks that I've made videos on that have done that, like Advanced Auto Parts, like Disney, I mean, a bunch of others where they lose a lot of money. But the almost the worst way and the more sneaky way that these stocks underperform is if you bought it, it was down like 10%, I think. So you know it was down 10% over this time. Meanwhile, inflation's up 20%. Okay? So you're really down 30%. But you don't realize it. It's slowly giving you your little dividend. It's going nowhere, basically. So there's not creating any excitement for anybody. It's just slowly losing people money year after year after year. And by the time they get sick of it, 10 years have gone by. And so when you pay too much for a stock, and granted, these years aren't really Medtronic's fault. This is like COVID. You know, people weren't going into the hospital and getting things that they needed. But they also recovered. They also got a big bump from the reopening. So they earned some of that back, which we saw is not a new trend. Then they're back to their normal trend. So it's just very deceptive. You have to be able to do like a valuation analysis, and you can't look at the price, just the price performance. You have to look at earnings. You have to look at what people are paying for those earnings. And the truth is, these guys have been growing about 2% according to Fast Graphs. That's from point to point here to what they're expected to do this year. When I look at the earnings, I actually have 1.87 because I take into account the downturns. But honestly, they're the same. It's returning 2%. That's not even what it's growing. Earnings are growing about 2%. That's less than inflation. The trend is down. But I was bearish on it before the trend was down. So, but if we want to do an analysis now with about 2% growth, so the way to think about it is, I have if you include the debt, the earnings yield is about 5.13%. So that's, if you bought the company for $100, you could take out about $5.13 in earnings each year. And if you own the business, that's what you could do, and you could go spend that money. So that's the way I think about it. And then that's only growing at 2%, but it is growing. So I want to see how much cash, if that trend continued over the next 10 years, I would have on my $100, and it's about $157. So that translates to, if you put that in a Kager calculator, wherever my Kager area is here, 4.61%. So that's even worse than the market. To me right now, this is a pretty clear sell. I'm not sure why anybody would buy it unless they thought they were going to turn things around, which I just always assume they aren't going to turn things around because I'm just like that. So yeah, I mean, 4%, you can get better than that on cash. You can get a better expected return from the S&P 500, even though it's done better 60% since my last, or not since my last article, since my last bearish article in 2019. My last couple updates, I had a hold on it. I think it's actually gotten worse since then. So yeah, earnings are going down. So it's even gotten worse since then. And I think it would be, I think this is a pretty clear sell to me. I just don't see anything. I don't see anything attractive about this stock at all. It's like ho hum, probably 17 PE and 2% growth. I mean, now I always try to kind of look at every angle. If earnings really do pick up to 6 or 8%, let's just be really generous, and because fortunately I can just type it in and see. Okay, now that's about it's a little better than where the market's at, right? If we took the next year's supposed to be 6% and then 8%. So if we took the average of those, this is closer to like a market average. So that's optimistic. That's like if things go well like they're supposed to, then you can do average. So those aren't the setups that I like. So for me, this one's a sell, unless somebody thinks they're going to come up with something new that's really going to like generate a lot more earnings. I think it's just, you know, cash, like treasury, short-term treasuries or the market probably do better. Okay, thanks for watching. Sorry the bad news if you own Medtronic, and I will see everybody later. Bye.